Welcome back, my wonderful people. You're back. I'm back. We've got some learning to do today. During times of market volatility, I'm committed to helping my YouTube community sharpen their fundamental and technical skills. If you are a returning friend, welcome back. Let's get back to work. And if you're new, welcome. Join me on this adventure. Let me help you develop some new skills today. And if you are a Patreon member inside my investment community, thank you as always. I continue to look forward to serving you. Before we officially start, Chinese New Year is coming up soon, and I wanted to wish you all a happy Chinese New Year in Chinese. 祝大家春节快乐，身体健康，股票市场赚大钱. Translated into English, it means I wish all of you good health and hope that you make a fortune in the stock market this year. Today we're talking about both the RSI Trading Indicator and the concept of relative strength, which are two separate concepts. In addition, I will overlay fundamental and macro analysis when I talk about some of these topics, so stay tuned for that. We'll cover the theory and the knowledge behind what you need to know about these two trading indicators. Now, for my YouTube friends who are CFA candidates, do know that technical analysis is a small portion of the CFA curriculum, but it does make its way into the exam. So I will do my best to incorporate some academic elements to help CFA candidates refresh their material too. Then towards the end of the video, I'll use these tools to help to attempt to understand the extreme volatility that we're seeing in the market today by assessing the S&P 500, the NASDAQ, and the Chinese Internet ETF KWEB, since that covers Alibaba and Tencent, with the RSI indicator that I'm talking about, and see if it has any predictive power. Once again, these investor education videos can be referenced later, so save them in your Watch Later tab and refer back to them if you need. While I personally prefer fundamental analysis, I do think the RSI index can add some nice context. So with that said, let's get into it. Okay, so I'm going to walk you through both the RSI and relative strength. And I know that they both sound very similar, but they're quite different. And I'm going to start off with RSI. The RSI index stands for the Relative Strength Index, and it's computed over a rolling time period. This index compares a stock's gains with its own losses over a set period. In other words, if the stock is on an upward momentum and continues to rise, the RSI will also rise. Conversely, if the stock has downward momentum and continues to fall, the RSI will also fall. Now, let me walk you through some of the technical aspects of the RSI index. The creator of this index, his name was Wallace Wilder, proposed a 14-day time period. So whenever you use the RSI in your brokerage or on TradingView, understand that this is the default time period. Now, before we go any further, I want to let you know that a lot of market makers and quantitative hedge funds know that retail investors use the RSI's standard settings. Therefore, they will actively trade against these signals to render them sometimes less reliable. So you do have to be aware of that. Use the RSI as another data point, but do not make full decisions from just this indicator. I want to walk you through the mathematical formula of the RSI so that you understand how it actually works. Here, I've got the formula on the screen, and you can see that the RSI is the sum of all the up changes for the period divided by the sum of all the down changes of the stock that we are studying. So mathematically, that means that the RS figure gets larger when things are rising. Therefore, when the RS gets bigger, so does RSI. Now, typically, an RSI level below 30 indicates oversold, and a level above 70 means overbought. But I will go into great detail soon as to why you cannot use this in isolation to make decisions. Now, the RSI indicator is primarily used to analyze the inner momentum of a stock. Whenever the RSI rises or falls in isolation isn't necessarily the most valuable analysis. A first stage analysis comes from understanding something known as divergence. Here is what divergence is. When you have the stock price and the RSI going in different directions, that's called divergence. A positive divergence takes place when the stock is recording a new low, but the RSI is recording a higher low. What this suggests is that while the price is heading lower, the inner momentum is improving and the selling pressure is potentially decreasing. Now, a negative divergence is exactly the opposite. If you have a stock that is reaching a new high, but the RSI is tapering off, tapering down, it means that the inner momentum is potentially deteriorating. Now, divergences are early signs of reversal that may foreshadow and anticipate a later on moving average crossover, which indicates that the trend has truly changed. So divergences are early signs, whereas moving average crossovers are confirmations. Now, I'm going to use an academic example to showcase this, and then I'm going to follow up with current market examples later today. I want to help you build a foundation using this tool before showing you real live charts in today's market. So here's an example pulled from the CFA material on analyzing oil between 2014 and 2019. Up top, we have the RSI indicators, and below we have the chart of oil. We can see that between 2014 and 2016, oil fell from $100 a barrel to under 30. Now, let me remind you what happened during that time fundamentally and from a macro standpoint, so that we're not just looking at the RSI and the chart itself, which in isolation is just one part of the puzzle. Now, between 2014 and 2016, there was a substantial oil supply glut in conjunction with weakened global demand. The global economic growth during those 2 years were soft, and because geopolitics risks were low and US shale oil made great efficiency gains in those years, this lowered break-even prices and made US shale oil the marginal producer on the international oil market. Now, this explains the fundamental backdrop of the oil price breakdown that you see on this chart. Now, from the technical standpoint, you can see that there were 3 lower lows between 2014 and 2016 marked here on the graph of the oil price chart. And during this time where oil made 3 lower lows, the RSI index made 3 higher lows. Now, this is called positive divergence. And the price of oil would later rebound from its 2016 low and break above the 200-day moving average. Now, this image says a 40-week moving average, but for all intents and purposes, it's essentially the 200-day moving average. Now, here is the catch. The technical indicators that I showed you do not move the price of oil. It helps us understand the early signs and then spot confirmation later. The challenge in every single trade that you make is that your transaction could be too early or it could be too late. Technical analysis is a guide, but not by any means the only tool that you should use. Here are some lessons that we can take away from this. Oil was below the 30 RSI level for quite some time before the long-term trend reversed higher. Being oversold on the RSI index does not mean that a sustainable bounce is coming right away. It tells us that the market is currently being controlled by the sellers. Now, you have to consider the RSI in the context of the overall trend in the market when you combine it with other indicators. As an example, oil being oversold while the price is still below the 200 moving day average does not mean that the price will immediately break back above its longer term trend. That technical analysis must be combined with fundamental and macro analysis in order to give you the greatest chance at success. Now, yes, this is my personal opinion, but I almost never use technical analysis in isolation without considering the macro and fundamental story. Now that I've gone through the RSI, I want to briefly talk about relative strength, since it sounds related, but it's actually quite different. Now, do not confuse the terminology. RSI and relative strength are different concepts. Relative strength is not comparing a stock's inner momentum against itself. Instead, it compares the performance of a stock to that of some benchmark, like the S&P 500. Now, this metric is used to help you understand the outperformance or the underperformance of an individual company relative to some other index. The way to analyze this is to prepare a line chart of the ratio of the two prices with the asset under analysis as the numerator and the benchmark in the denominator. Now, intuitively, a rising line shows that the asset is performing better than the benchmark of the other asset. A declining line shows the opposite, and a flat line shows neutral performance. Now, I'm going to show you a historical example to help you visualize how it works. Here we have an image of the relative strength between Amazon and the S&P 500 between 2011 and 2018. You can see that between 2011 and 2015, Amazon generally outperformed the S&P 500, but it was after 2015 when the outperformance was very large. Now, between 2011 and 2015 was a period marked by economic softness relative to the second half of the decade. Defensives typically did better while the growth names were in line with the market in terms of performance. Here's another example that illustrates this. Here's a chart of the relative strength between consumer staple Walmart and the S&P 500 between the same time frame of 2011 and 2018. You can see that throughout this period of time, Walmart, which is a defensive name, did better than the S&P 500 from 2011 to 2015. And as the bull run accelerated, defensives and value names such as Walmart underperformed the S&P, and tech secular winners outperformed post 2015. Now, this analysis can be helpful for you to spot which names and themes are likely to continue their strength in the current environment. Now, all of this so far has been great academic exercises, but now let's put all of this together by combining the technical analysis with macro and fundamental analysis into some real examples. We're going to dive into the S&P 500, the NASDAQ, and the Chinese internet ETF KWEB, where Alibaba and Tencent are big components. So first, let's talk about the S&P. All right, we can see here that the S&P 500 is now approaching the 30 level on the RSI index. And that means that the S&P on a technical level is oversold. However, the S&P 500 is also very close to its 200-day moving average of 44.33. So objectively speaking, risk-averse investors may want to wait until the index reclaims that long-term trend line. Fundamentally speaking, the S&P 500's PE ratio is around 19.5, which is considerably lower than the 21 times multiple at the end of 2021. And out of the several sectors that have reported so far, most companies have beaten on the top and bottom line. But the offset is that guidance is a mixed picture across the companies that have reported. Now, corporate profits are still strong, and there is still aggregate growth in S&P 500 EPS estimates. On the macro side, we have softer consumer confidence and several rate hikes planned for this year. But we do have an overall economy in growth mode. So for now, stagflation is a risk, but it hasn't fully materialized yet. Net, I see the S&P 500's risk reward as even here, slightly positive. I do see the S&P 500 as a safer place to park capital in the near term than the NASDAQ, since we currently are in a risk-off environment. And now we'll talk about the NASDAQ. So the NASDAQ's RSI is also very close to 30, also indicating oversold levels. But again, we need to consider additional information, such as the fact that the index is nearly 10% below the 200-day moving average, and the current investment narrative of monetary policy tightening is much more of a headwind against NASDAQ component stocks than S&P 500 component stocks. You can see that the RSI does not provide enough information to indicate that a divergence is forming because we are so early in this correction. Yes, I know that it feels like this correction is painful and has lasted a long time, but objectively speaking, there is not enough information from the RSI to indicate that a divergence has formed. Higher lows have yet to be formed. It is time to start forming a watch list of companies that have the attributes to be successful in this environment. It is not time to invest the last dollar that you have in the hopes of a rebound. Now, I'm currently telling this to my Patreons. The time to add risk is approaching. So it pays to be prepared, but being selective, careful, and ready to peel back positions if we're wrong is the most important principle that I'm currently advocating. I'm trying to protect the capital of my community and wait for either risk reward to improve or at least a lower volatility to restore confidence. In my January investment strategy deck, my research provided to Patreons was that Microsoft is a buy and hold on dips candidate. Trading Microsoft is likely a mistake. My fundamental and technical work showed that Microsoft had strong support at the 270 region indicated in my investment dashboard. After earnings, Microsoft did initially approach this level. After reiterating guidance, though, the company bounced off this level very well. Now, my style is buy and hold, but for my community, I'm sharing with them a methodology which I'll call buy and hold and also review, which allows them to understand any risks that they might not know about in their portfolio. We do this through concise strategy updates, informing them about my positioning and updating the bull and bear thesis to consider. If you like this way of investing and are long-term in focus and are not concerned about the day-to-day movements, then definitely join my inner circle, where I also provide education to sharpen my members' analyst skills. Now, back to the RSI, I think that as of right now, taking a long position in the NASDAQ or QQQ has decent upside, but it also comes with the highest risk. You're acting on the early stage part of the indicator rather than waiting for confirmation if you take a long position today. At the same time, if you wait for confirmation for the 200 moving day, the NASDAQ will be back at 14,700, and much of the alpha will have been consumed. So that said, the intermediate term trend is still negative because the NASDAQ is below the 200 moving day. So going long right now is considered to be contrarian. Now, as painful as it is right now, I am still bullish and I invest with the long term in mind. I am still positive on the secular big tech winners, and I believe that we are going into a stock picking environment and a more defensive environment in general. As you can see, technical analysis can give you one more data point in your decision making, but it really is one piece to consider over the overall context. And finally, the Chinese internet sector, a topic of great interest to my international YouTube friends. Here, we have the Chinese internet sector's K-Web ETF in the chart of the RSI. You can see that the ETF is below both the 50-day and the 200 moving day average while touching long-term horizontal support. Now, this has been an incredibly challenging environment for all equities, and Chinese tech is no exception, but things could be turning around soon. Let me show you. Here, you can see that although the share price is back down to horizontal support over a long time frame, the RSI is finally making an attempt at a positive divergence. However, it's only 2 points of data. It's a good start, but it does not make definitive conclusions from the RSI because the price has been below the 200-day moving average for more than 180 days now. Now, more important than the RSI for understanding Chinese equities is the macro climate in China. Given that Alibaba and Tencent are among the largest components of K-Web, the health of these two companies is very important to analyze. Now, China's National Bureau of Statistics indicated that online retail consumption grew 2.8% in December 2021, which is actually a historical low when viewed year over year. This means that consumer sentiment is still recovering from the softer macro climate. Now, policy surrounding internet regulation is likely to taper down from all the changes made in 2021, but once again, sentiment still requires time to recover before institutional investors feel comfortable increasing their allocations again. This softer macro backdrop will require Alibaba several quarters to recover, like I've said in my public videos and YouTube community posts. It will recover, that is for sure, but this is a name that will require patience. To analyze China, technical analysis is probably only 10% of the decision making. You'll likely find more success with fundamental, macro, and political analysis to understand the big picture. Now, for the long-term outlook for Alibaba and Tencent, I continue to believe that they have strong business models that can weather this challenging environment, but patience continues to be key. For Alibaba specifically, since I know this is a very big name of interest, my notes on Patreon indicate that I'm patiently waiting for an entry below 110 or an entry above 130. I see that anything in between this range is really no man's land. My core Chinese tech position is in Tencent, and I believe that it does have lower upside than Alibaba, but I also think that it comes with less risk. Now, if you've been following me for a while now, you know that I still believe that the Chinese internet sector will come back, but like I said in one of my previous videos, it's looking at the minimum to be a second half of the year story. If you want to follow my research as to how I'm navigating this challenging environment and build the skills to become a better equity analyst by learning institutional investing frameworks, friendly links are below. I will be creating more investor education videos like this to help you. Feel free to connect with me on LinkedIn, Instagram. I want you guys to know that I appreciate all of you. And if you celebrate Chinese New Year, I wish you a prosperous year ahead. Thanks again for watching, and I will see you next time.